Can anyone else hear Ryan?
I can't hear him. No.
Okay.
No.
Ryan, I think you.
I was putting on a good performance, at least, right? It looked good.
No, it looked good. I didn't know.
There he is.
I saw you making the faces. I thought you. I was like, okay. He's putting.
It was like when CNBC had Alan Greenspan on, and then he wasn't on. Carl Quintanilla just looked very blankly.
Okay.
That's what we were all doing.
All right. Well, we will take that again. Then what I was saying was, welcome everyone to the Future of the U.S. Shale Roundtable. If you have to hop out or leave, it's okay. You will get email from the War Room newsletter, which is where the recording will be hosted for all of those who have registered and sent me a thing that you can't come. You're now seeing this. And for those of you who have to leave, there's where it will be. We have today David Blackman, Ellen Wald, Anas Talahaji, and DRW, the man, the myth, the legend. That's how you wanted to be read, right? That was
exactly the man, the myth, the legend. I'm very popular on Twitter, EFT as well.
EFT, yeah. They crucified me for the $10 fee for this thing, so just so you know. But anyways, okay. Where we're going to start at, if you have questions, I will turn it on here in a second so you can send them to me, and we'll try to get those at the end. Where we're going to start at, and we'll start the first time with David. We'll go David, Ellen, Anas, DRW in that order. I want to go back to January, because the shale industry, I don't know if you guys know or not, it's controversial. There's a lot of opinions about it. So back in January, before COVID, before the pandemic, before the price war, what was your general thoughts of the state of the industry? Mr. Blackman, we'll start with you.
The state of the industry in January was very tenuous, and to a large extent, but specifically the shale industry we're talking about. To a large extent, that's because the general business model of shale E&P companies is reliant on all the other oil-producing countries in the world, effectively, the members of the OPEC Plus agreement, to restrict their own production in order to prop up the oil price high enough for shale wells in the U.S. to be profitable. That's a bad business model. As we saw in early March, that OPEC Plus deal is very tenuous itself and prone to being blown up, as it was by Russia and Saudi Arabia in early March, and we had the price war for about 6 weeks, and price even went negative one day. So I just think the industry itself was already not in good shape. It was having a really hard time accessing capital, and that's only become harder as the year's gone on, and we've had this COVID pandemic, and so I guess I'll just leave it at that. That's my view.
Okay, Ellen, any added or disagreement, or how would you phrase that?
Yeah, I think it was in decent shape, and I say that more because I was looking more towards the future. I think we were definitely in better shape than we were in 2014. But I do think that in general, the prospects for the future looked better than they had for some time. Pipeline infrastructure was improving. We had a number of pipelines coming online, and also there were improved prospects for exports with the China trade deal. So I think those definitely improved the outlook. But of course, there were still a lot of issues, including costs that still rise along with prices, excessive NLGs for the market, and also marginal companies that were producing just to stay afloat. So there were definitely a lot of weaknesses, but I think the future looked brighter in January than we thought it would be.
Anas, to you.
All right, where to start? In 2019, we've seen the rig count decline throughout the year. The shale industry was suffering not only because of relatively low oil prices, but most of the suffering came in from negative natural gas prices, from low natural gas prices, from surplus of NGLs and the price of NGLs. So we've seen all kinds of problems. And then we've seen, of course, the infamous crude quality issues that we always talk about. But to prove the point that shale was suffering, if you look at private equity and what they've done in 2019, I mean, they were on the sidelines and they were suffering, and investors were really angry, and they did not know what to do. They cannot invest. They want to invest. They don't know what to invest, etc. So the writings were on the wall all over 2019. Just look at private equity distributions. Almost nothing. and I'm talking about almost all of them. If you look at their investment was really minimal, simply because there were no opportunities. And one of the other signs is the reason why we are not seeing mergers and acquisitions, and we did not see it in 2019, and we are not seeing much now, is because of the valuation. And we have serious issues with valuation. If I own, I mean, think about it. Whiting went through bankruptcy and refused to offer itself for sale just about a year and a half ago, simply because they know that the valuation was very low anyway, and the same applies to Chesapeake and others. So we have several issues in shale. Most of it is related to natural gas and NGLs in 2019. The other issue is the service companies were literally providing free services. So they were suffering throughout. Service companies did not make money in 2019. So the writing was on the wall. We had several problems, and by the time we got into the Russia-Saudi war and COVID, basically everything was almost ripe for a collapse. And if you look at the rig count and how it collapsed in just like in a matter of about 3-4 weeks, that's evidence that it was just ripe for collapse.
DRW?
Yeah, I mean, I would build on what Ellen said, and I would specifically say, going into this year, I personally was positioned long oil, and I was really excited in the way that you can be excited about an assassination via missile when General Soleimani was assassinated January 3rd. Because I had done some posting. For those who follow the Hot Take of the Day blog, you know that in September of 2019, I had been writing about the reasons that U.S. oil was not going to grow in 2020. And the primary reason was, number one, we'd push lateral lengths as far as they could go. Number two, we were drilling wells too close, and then tier 2 inventory was more prevalent than tier 1. And the most important reason was that the underlying declines of each of the wedges. And so a wedge is wells brought on in 2019, their decline over the first 5 months was steeper in every single basin across the United States all the way through 2019. And so in November of 2019, according to the EIA 914 report, we actually peaked U.S. oil at 12.8 million barrels a day, and we declined for 5 months after that. We assassinated an Iranian general that would have solved some of the OPEC issues, and COVID hits. And so we moved from this crisis of balance sheets where it was high debt, but commodity prices looked like they could be stable, to what we're going to talk about, which was March 6th, and the end of the shale business model in the United States. And so that's how I really bifurcate the pre-March 5th, March 6th, and the post-March 6th. We were going in with weak balance sheets, but prices were going to save people in some cases. And then March 6th came and negative oil, and we've seen what happened. So those would be my comments to add.
Okay, so I know we always have these dates where we know we were. I know where I was when the Russians walked out of OPEC and said, screw you guys, I'm going home, basically. And I remember calling someone and saying, hey, this might be as a service company owner, this might be the end of it for me. This was pre-shutdown in the U.S. I knew at that point that it would be bad. And it's not that I'm a rocket scientist, obviously. It was going to be bad. We don't know what would have happened, obviously, at the shutdowns, but how much do you think that, because we saw reactions from our clients immediately before the shutdowns, they were starting to pull back rigs, cancel pipeline projects. How much do we think that impacted the U.S. shale industry before we even got to the shutdown? We'll start with you and us.
Generally speaking, people were scared to death from that price war. The Saudi reaction was, look, if everyone is going to produce at capacity, I am going to reduce at capacity too. But if you redo the analysis, we would have ended up with negative prices no matter what. Even without the Russian, Saudi, in a sense, they just expedited the fall. But the impact of COVID basically is so severe that we would have the same result anyway. But what happened between the Saudis and the Russians will be always a reminder to everyone in business that this is a risky business, and it is in the hands of several players, including politicians in the U.S. and outside the U.S.
So go back to you, DRW. One of the things I remember you putting out was basically we're at World War III. We've got to shut down everything. We've got to furlough everything. And I remember sitting there thinking, I don't think that's going to work, because knowing, kind of how my business works from the service side, it's like, okay, that it sounds nice, but unless, Trump can write me a big check, it's not going to work. We had the PPP kind of come out and some stuff that kind of push things back a little bit, but you still stand by that position. Obviously, maybe you might agree with the attacking our industry, but just how you thought we should have navigated those streams, knowing what you know now. You're muted. Sorry.
Yeah, there you go. See, now I did your trick.
Yeah, there you go.
I mean, on March 8th. So it was a 12-day period where I was still strongly of the belief we were never going to shut down the United States for COVID. Now, I was illusioned by the Chinese data saying 45 deaths a day, and I probably should have factored that up by the factor of like 1,000 or whatever the number was. But nonetheless, we've seen it, and we saw it in the Diamond Princess, and we saw that there was 3,900 passengers and crew, 700 got sick, 7 died, which was a 1% fatality rate. 20% were going to get infected. So my view at the time was there was enough data. 14 NBA players out of 450 had it. Therefore, you could imply 10 million people already had it, and we weren't seeing death rates. So I could not fathom the United States doing what we did on March 18th when California shut down, March 20th when New York shut down, and then every governor was like having a race to virtue signal to shut down faster, except for our beloved state in Florida, who I love very, very much. And so the combination of the lack of demand, which obviously Anas talked about the fact that in January, Chinese demand was down from 13 million barrels a day to 10, and oil prices went from 53 or 63 to 50. Then the Russians drove it to 42. Then the Saudis drove it to 34. Then COVID took 35 million barrels a day off the market for 45 days, which is 1.5 billion barrels in inventory. I went on CNBC, I think March 18th, and I told Brian Sullivan, oil will hit zero. This is cataclysmic. All U.S. operators need to shut in 100% of their wells for 45 days. Otherwise, there's no other result. And it happened. So I still stand by the view that the U.S. response should have been more severe, which is to just shut in wells for 45 days and not sell barrels at a negative price. That being said, the financial destruction and the fact that we're 36 today, there was no escaping that.
Yeah. Okay. Ellen?
Yeah, I think I have maybe a slightly different perspective on the Saudi-Russian issue. I don't even like to call it a price war, because I didn't really see that kind of price response from Russia. I think that Russia was pretty clear in signaling what it was planning to do at that point, and Saudi Arabia wasn't hearing Russia, I guess, or thought that maybe they could kind of call Russia's bluff. It wasn't a bluff. On the other hand, it wasn't a bad strategy for Saudi Arabia to pursue in a world where the entire economies of the United States and Europe weren't shutting down. So the idea of kind of using their spare capacity to overproduce and kind of punish them is not necessarily bad for Saudi Arabia. It was a gamble. But it could have turned out, I think it actually might have worked for them had everything not shut down, because they would have made up lost revenue by just selling more barrels. But then everything shut down, and they persisted in overproducing through all of April. And Saudi Arabia didn't have to do that. That was a conscious decision to do that. And I think that legacy will live in the market for a long time, because now everyone knows that if Saudi Arabia threatens this, they will go through with it, or at least they can very well go through with it, and they will. There's everyone. I think some people didn't think Saudi Arabia actually could produce at 12 million barrels per day. I was not one of those people, but there were definitely people who didn't think that they actually could. They can, and they will. And so anytime Saudi Arabia decides to pull that card out of their pocket and threaten someone, could you see them maybe threatening Iraq for non-compliance at this point, saying, hey, we can overproduce, and we will, and the market will believe that, because they have believed it. And I think that is a threat that looms over the market as a whole going forward throughout all of this. And so it's you can't. I think it's hard to separate the shutdown and the demand problem from the oversupply problem when we look at it.
Okay, David, I want you to wrap this up, but I also want you to weigh in. How much do you think President Trump helped maybe expedite these two from continuing on? Because when it started, we had you on the Texas Oil and Gas podcast, and you were like, "Well, it might be a week or two. We don't know." And that was kind of
well,
well. I mean, I think
at that time, I think that was kind of my outlook for sure.
Yeah, right. We were all kind of optimistic, right? We were like, okay, hopefully they'll wrap in a week or two. But it felt like they kind of just hunkered down, despite there was no really good reason to. So, thoughts on what they were doing, and then how much do you think Trump's role to kind of get them to back off played into it?
Well, I think the president put as much pressure as he could, particularly on Saudi Arabia, where he has more leverage. But whether that had a big effect, I don't know. I mean, yes, we found out Saudi Arabia, when they threaten to do this, they will do that. But I don't think we know how long they necessarily will be able or willing to maintain it in the future. I think they maintained it for as long as they could stand it economically. The impacts of it economically, because, I mean, they need higher prices than we have today, frankly, to really sustain their social economy. And, so the president may have had an impact, maybe not. I don't know. He put a lot of personal time into it, and where the Russians are concerned, again, as Ellen said, I think the Russians made very clear what they were going to do, and they did it. And to the other point about COVID-19, had already had a major impact on oil prices before they even did that. I think West Texas Intermediate was at 46 on March 4th, right? And so it had already tanked by 30% just due to COVID-19 impacts. We'd already lost by March 6th 10 million barrels a day, I think, at least in demand. And so, they just played into each other. Certainly the situation with OPEC Plus blowing up exacerbated it all. But as David said, I think, prices probably would have gone negative at least for a day or two anyway. It was all baked into the case already. I just didn't know that when you and I did that podcast.
Right. Well, no. I'm not. Yeah, it's more of just kind of the time capital and what we know now. Just kind of around the horn really quick, unless anybody has anything they want to add on the OPEC stuff. We'll do we think that the U.S. shale industry has responded the best way that they can? And I hate saying the U.S. shale industry because there's a bunch of companies, and that's kind of the problem we have to talk about this. But generally speaking, are we pleased with how the shale industry has responded? Some companies better than others. I see DRW shaking his head no. He feels strongly, so we'll let him go first.
Well, I mean, two things I would say, and I think David made the point. The U.S. was coming out with their Q4 earnings and their 2020 projections in February. And every other company in every other industry was saying, due to COVID, we are doing something different. And U.S. companies, SM, EOG, Pioneer, everyone said, we're growing 10%, we're growing 12%, we're growing 14%. Aren't we great? And so to me, it was absolutely mind-numbing that we continued to think that in a world that grows 1% demand a year base case, the companies thought they could grow 12% and this was a good idea. And then we had the debt. Now, I will say once prices were in free fall, short of the federal government shutting in federal leases and shutting in Gulf of Mexico production and then paying some stipend to help like producers, we're now in just a survival mode. And so each company is to each their own. But every day we see more bankruptcies. I expect that the actual pain of the bankruptcies will occur in November. PPP will be exhausted. Unemployment rate will actually be the unemployment rate, not this fake 8.6%. Businesses who've been barely keeping open, like restaurants, will actually have to close. Last night I went and saw like 15 people at a restaurant for 300. That wasn't capacity restrictions. That was people aren't going out. That restaurant's going to close. And so when all of that comes, Shale needs to wake up and say, how do I survive? So I don't think they did a great job early, but now it's like you're in a fight with Mike Tyson. You just got to try and get punched as little as possible.
Anas, we'll go to you. What do you think about Shale's response?
Yeah, I think we've seen several problems that were really strained in several ways. When companies asked President Obama to allow or to lift the ban on exports, they were talking about competition and how they are going to compete with the world, and we need free markets. The same people who were talking about free markets, they went to the Texas Railroad Commission to ask them for mandating pro-rationing. They went to Oklahoma, they went to North Dakota, the same people. That's not a good thing to do and not a good way. You have to be consistent. And if you are talking about free markets for 40 or 50 years and you've been in this business, and then you go and ask a state agency to help you out, this is a major disaster. So that's number one. Number two, we have seen their responses where they were all of a sudden, when they started shutting down production, they were talking to senators basically to impose restrictions on imports, to impose some sort of sanctions, to impose some sort of tariff. This is not an industry. It gives you the impression that this is not an industry that is based on principles. And that was shocking to me, because they were preaching free markets for a long time without naming names. We have CEOs who went to OPEC seminars, basically challenging OPEC inside the building of OPEC and telling them, we are going to beat you and our production is going to go to 18 million. And those guys are looking at him and now they are laughing.
Can you please name names? We'd prefer that, actually.
No, I don't think they've done a good job.
Okay, Ellen.
Oh yeah, I mean, I think that the biggest thing that matters right now is demand, and I think that demand is going to depend. I think that over the summer we were kind of hiding from a lot of the problems that the underlying structural economic problems that we're seeing. I mean, we're not yet feeling the full effects of this recession, because you're talking. I mean, big companies have only just started to lay people off, and you know, we're going to be seeing that for a while. I think there was perhaps an opportunity to allay some of this if we kind of conquered what I call the fear factor that has been in place, that people have been made to be so scared of COVID-19 that we need to actively combat this fear so that people will feel comfortable going out and existing in the world and being part of the world. And we're not going to see a true recovery until we get past that fear. And so we're barely even touching it at this point. And so I think we may see like restaurants may start to reopen if there are any left, and if people will go, which I'm skeptical about because fear. But I think that's going to then trickle up, if you want to say, to trickle up from these service industries. Well, then you're going to see it in the marketing companies, and you're going to see it in the big law firms. You're going to see it everywhere. It's different from the last recession, which was like a financial problem that then kind of later hit the every guy. This is coming from the main street, and it's going to go up, and we haven't seen that yet. And until kids are back in school full time, the economy cannot really fully resume. And so demand is a huge factor in this. I do think, though, that November will be telling. I think that when we look and see what the travel data is in terms of driving and flying for Thanksgiving, we may get a sense of where, how far we really do have to come to see a demand recovery.
Mr. Blackman.
Well, I'm also going to avoid naming names. But I think the industry's response, as we've been discussing here, kind of points back to the difference, the qualitative difference between the U.S. industry and these national oil companies or states that, basically have command and control of their own oil business. Every company's management team responds to the pressures that they have on them every day. And so they're responding to pressures from investors, pressures from Wall Street, pressures from that crazy Kramer guy on CNBC, pressures from their employees, pressures from their spouses at home and their kids. And so every company is making the decision that their management team on that day believes is in the best interest of the company. Well, every company is situated differently. And so you saw this very disjointed response from the industry because, companies do what companies do. Yes, but as a general rule, I agree the industry's response was not adequate. It was not really very good. We didn't shut in enough production. We have restarted production way too soon. Some companies have restarted their drilling programs way too soon. Are going to, frankly, regret doing that. But again, I just think that kind of points up the reality of the U.S. industry and the disjointed nature of it being, consisting of 1,000 competing companies with one another.
Okay, so we have a question from the audience, and this ties into where we're going next. And it says, how interested are investors to invest in the shale companies again after all the bankruptcy? And so that's the question from the audience, and I want to couple that with the credibility question. Whatever you think about the media's coverage of oil and gas, obviously the public perception of oil and gas is not very good, at least in some parts of our country. Also, there's this narrative of maybe the shale producers have misled Wall Street over the past decade about how they're going to make their money. Now, you can pick that apart or talk about that however you want to. It is a narrative that's out there that the shale companies will have to deal with, whether you think it's a rightful or wrongful narrative. It's just part of it. So, David Blackman, we'll start back with you. Just Wall Street, are they going to be cut until we'll back to 100? I mean, what's it going to take, or what it would take to get Wall Street back into it?
What it's going to take is for companies to become profitable. I mean, profitable in the real world, and not in a world where 23 OPEC plus countries are shutting in their own production so that they can go drill their new wells. Okay. That's not really being profitable, because that deal's going to fall apart again in the next year or 2 years. And we're going to go through this all over again. And the industry cannot continue going through this every 2 or 3 years, because at some point, kids coming out of college will just refuse to go to work in the oil and gas business. So investors will come back when profits come back, and true, real profitability comes back. And that's going to require a whole change in business practice and business mindset within all of these companies.
And real quick, before everyone else hops in, what's the price point? Because I want to talk about technology stuff at some point, but is there I hate to say a magic number because they're all different, but is there kind of a general area that price will have to be at for a prolonged period of time? Or is it a cost-cutting endeavor that we can pull off? Obviously, a little bit of both. But
Ryan, when I show my slides, I will show something along those lines.
Okay.
Good. Sorry, he's more qualified than I am to answer
that. Sorry to interrupt. I just want to mention that.
No, I'm done. Yeah, go ahead. Seriously.
Go ahead, Anas.
No.
Yeah, go ahead, Anas.
Thank you. All right, let me see. Turn screen on. I'm trying to figure out what to do here.
Yeah, right. The
screen.
I usually make slides, but I never actually talk to any of them. So I've decided as my new thing, like I could just show a picture of my kids.
No, I don't know why this is not working. Oh, definitely, man. This is not working. So let me see what I need to do.
Okay. Well, while you work on that, go ahead, Ellen. You get your hand up. Or
please, yes.
Oh no,
Ellen, you're on mute now.
Sorry. I'm not sure that we actually need to see like true profitability to see investors jumping back in. I mean, people have been investing. We've had Wall Street has invested in oil and gas for 160 years, and there are ways for investors to make money that don't involve, actually, getting profits out of the company. I mean, look at, some of these tech companies that manage to grow and expand and make, investors very happy for years without actually making any profit. So I think that we don't necessarily need to see the kind of classic profits, in order to get Wall Street back in. I don't think we'll necessarily see the same kinds of investors. They may see investors of a slightly different type, or who are much more available to engage in riskier investments than the kind of like regular banks.
So I'll jump in on this because I like to be controversial. So I did a little post this morning in preparation for this. I know this comes as a huge shock. So my base case is that not investing in oil and gas has nothing to do with ESG. ESG is a very convenient excuse, but like we all know bankers, and we saw them in 2008, and we see it again today, that they would sell their grandmother for $1 if they could. So the core issue is, if you believe the stock is going up, you will buy it, ergo Tesla, which makes absolutely no logical sense trading at 15 times revenue, but I digress. Now, the reason that oil and gas investors will not come back is the following. In the first half of 2020, Exxon had $6.3 billion of operating cash flow. They spent $11.5 billion in investing and $7.5 billion in debt, in dividends, which then they paid for by taking $22 billion of debt. Now, if you do a very simple valuation, and this is going to be quick and so people can get all upset with me, but if you take their smog, which is the standard measure of oil and gas, using a $55 flat deck, a $2.57 gas price, run out Exxon's next 5-year development, they have $89.9 billion of PV10 at 55. Net off the debt and then come to a per share value, their per share value is $13.17. Then applying the same price to earnings ratio as Valero has to their upstream and downstream and chemical business, I come up with $5.63. When I add that, Exxon is worth $18.85 at $55 oil flat. Now, there's only one place for this stock to go, and it is to go down. And when Exxon trades at 10, I will be a buyer. Until then, I will be short Exxon through fancy ETFs, and this is not investment advice, but there are multiple ETFs that are short the industry, and that's what I meant. ERY, Doug, because the industry will collapse 50 to 80% in share prices over the next 12 months because there's no other way it can go because it's an NAV business.
Just to make sure I heard you right, you're not entertainment purposes only saying $10 shares for Exxon.
I am saying that no. I'm saying my belief, not investment advice, is Exxon will trade to $10.
Yeah.
Chevron will trade to 30, and many others will go to 0. So the best investment is to be short energy.
Okay, that's what I make sure I heard. Anas, are you ready for us, sir?
Please let me know if you see the slides. Do you see them now?
No, sir.
No.
What about now?
No, sir.
We're in a Verizon commercial.
Okay, so there is nothing there. You don't see anything.
No, sir.
All right, probably I need help with that then. All right, I am unable to share the slides for some reason, although I see it here that is being shared. I don't know. All right. Sorry. If someone can help me, that would be fine.
I don't. It's when you hit the share button, it should say your entire screen, application window. If you click the application window, if you're in like PowerPoint, that's where you click on.
Yeah, it's showing nothing on the application window, so that's the problem.
Oh, okay. Is it the Chrome tab or is it your screen?
It's an application. It's on the screen, and I see it when I share it. It just you guys, you don't see it.
Yeah.
Yeah. All right.
I can't. I'm not sure.
Okay. Probably I just talk about them then instead, if that's the case.
Yeah, go ahead. And I know you sent them to me. I'll see if I can get them to work on my end, but you go ahead on yours.
All right. Well, the first thing is about you asked a question about the media and investors and how the companies are presenting themselves. Basically, if you look at the quarterly report, the second quarter report, and I'm looking at a slide from Pioneer, they are showing a major decline in well costs from the original 2020 plan to the current, and it declined by $1.8 million. So it declined from about 9 million to 7 million. And they are saying that we were able to reduce well costs by 1.8 million through increased efficiencies and service cost deflation. And they expect that 60% of well cost savings to be sustainable.
Anas, real quick,
Yes.
Look at this. Tell me. I got the slides up. Just tell me where to go. I was here.
All right, let me see. All right. All right. Well, let's go to the beginning then if you have the slides.
Okay.
Let's go to the beginning. First page, basically, I'm just, you joked about the BP, and we talked about it yesterday. Basically, this is my reply to BP production, that all those pages from The Economist. So this is really a very old prediction. There is nothing new about it. Second slide, please. Second slide basically just shows the major decline rig count in response to the COVID, of course, and lower prices, etc. The main message out of this one is, even if we have 0 docks right now, we are way below the numbers needed to sustain production. Next.
Yeah. real quick, I do want to take a question. What is the general consensus of the panel on ducks? Do you believe the EIA data? Do you believe, is it Kairos who says we have substantially less? Just quickly, we'll start with Mr. Blackman. Ducks, what's your thoughts on the ducks and how many we actually have?
I believe the EIA data as far as it goes.
Me too.
Okay. Ellen? Agreed. Okay. Go ahead. Sorry.
Okay. Just to answer your question on my side, basically, I think what's important is which ducks will come online rather than the total. I think what can come online is about 15 to 1,800, and that's it. The 6,000 cannot come back online because of several reasons. So the question is, when will companies start drilling again? This chart basically shows the rig count per basin, and look at the gap in term between prices and how flat the rig count is toward the right, toward the end here. And the question is, when will they start? If you go back to 2014, 2015, given the natural gas prices and NGLs at that time, the threshold in the Permian was around $43. So anything above 43 means increased in drilling activities. Given that natural gas prices today and NGL prices are way, way lower, we need a higher price. Probably it is around 47 to 48 in this case to compensate for that decline in natural gas prices and NGLs. If we have a major increase in natural gas prices and NGLs, we will go back to about 43 or 42. Next. All right. And of course, when we talk about ducks, we have, of course, to separate between the rig count and completion. And this is the recent data from Primary Vision, basically. And you can see that the number, the frac spread is very low. And to add 350 just to maintain production, to add 350, that will take a lot of money and a lot of time.
And
so
a lot of hiring.
Yes. Yes. So we are not going to see this in 21, period. And probably when we talk about the outlook, we can come back to this one. Next. The question is about the Permian. We have to remember that we still have about 150 horizontal rigs basically are working in shale. So shale is not dead. We are still producing. It's just we cannot compensate for the decline over the long run at all. But we still have 150 rigs, which means that someone is making money in one way or the other, or barely making it, but we still have a lot of rigs working. And the question is, have we bottomed in the Permian? And based on the current numbers and based on current prices, it looks like we reached the bottom in the Permian. Next. All right. This is kind of very funny chart. It looks like, I call it the duck, but a different duck from the one we were talking about. The idea here is the rig count in the Permian goes in circles. And if we, of course, you have it in PowerPoint, I have it animated. You have it in PDF, so we cannot animate it. But if you look at it and start with that arrow in the middle, that's when rig count declined in 2015. And we are going to August 2016, where that big black circle is. And as prices started improving, basically, we can see that is going in circles, going up. Then we have kind of a flat price, but that was enough to increase rig count substantially. So this is a scattered plot, but it is really not scattered at all because it is going in circles. So you can see the prices on the left, the rig count in the bottom. So with the prices around 55, the Permian was doing fine, and we've seen a large increase in rig count. Then as prices increased above 60, went to 80, etc., we've seen this measure increase. Then natural gas prices start declining before oil, and we've seen that turnaround where the head of that dock is, and then prices crashed, and we went down. Then the rig count declined all the way, so we are going back toward the tail. We are literally at the bottom of that tail of that dock right now. And the question is,
you got to look on your face like you want to maybe have a question or something. So let me just let you hop in here if you got something.
No, I've never seen that plot before. I'm thinking of all the ways I can utilize it.
So what happened is now we are just waiting on prices to go back with that circle again one more time. Again, this is supposed to be a scattered plot, but it's not. It is really a circle going back and forth. And based on what I mentioned about natural gas prices and NGLs, it is very clear that we need a large or higher threshold than the past, where that red arrow basically is going. So at what price we will see that turning and going back the same way we've seen it before?
Okay. And Nas, can I just jump in for 1 sec on that? Because I mean, so this is the core debate: is what is the actual economics of U.S. shale? And I believe that the actual numbers require between $50 and $60 a barrel. And so, notwithstanding, I mean, I think the speakers previously said OPEC has been subsidizing us, and it's clear that they both fell apart for periods of time. So, I mean, of course, everyone says this time it's different, but I truly believe it is. And the one point I'd make is that Saudi Aramco went public in 2019 with a 53-year reserve life index at 10 million barrels a day. And notwithstanding their social costs, they can produce oil cheaper than we can. And if I were Saudi Arabia and the world were moving from oil, I would want my reserve life index to look a lot closer to Exxon's than mine, which means they would go from 53 years to 17, which means that they would have to triple production from 10 million to 30, and the world will be well supplied with oil at a price lower than U.S. shale companies can come back. I think that's the difference now versus the circles. That was just the one thing I was going to weigh in on.
I have a reply for you on the $50 to $60, simply because I think you are considering all the shale and all the wells and all the production. But the idea here is, if we look at the core areas, can they really do it at 40 and 50? I think they can. But if you are talking about the total of everything we drilled and everything we know, I think you are right. So in a sense, you are looking at the marginal price for marginal well. But for the core areas, shale we can produce about 4.5 million barrels a day at around $40 for a very long time.
Okay, before I want David and Ellen hop in here. DRW brought up Aramco going public. Ellen, I see your book back there. You've covered this topic exhaustively. How does that weigh in? How does that change what I expect for Aramco? What does it do to them? Because it's not just the different business model. There's different pressures as well.
Yeah, absolutely. I mean, it's part of the issue with the Aramco IPO and now the impetus on Aramco to not just pay a dividend that covers the costs of the Saudi budget, but also covers this commitment that they've made to basically pay a dividend to all of the Saudi people and others who have bought into this IPO. It really has, I think, changed the way that the company is functioning. I've always argued that Aramco has basically always had a very long-term view of everything, that they want to maximize the amount of money in the long term that they're going to make. And they've always been able to operate on a very long-term picture, never having to deal with the kind of share price fluctuations and pressure from shareholders that, Exxon, Chevron, et cetera, have had to deal with. And also that historically, the Saudi monarchy has really generally allowed Aramco to kind of do its own thing and not interfered with the day-to-day running of the company, the decisions the company was making, and that has historically been, the way that the monarchy kind of had a very hands-off view of Aramco, and Aramco provided, in general, there were certainly some times where they weren't providing a lot of money for the monarchy, notably the 80s, but other than that, their policies generally yielded lots of money, and the two were kind of very separate, and it worked very well because Aramco was, not having to worry so much about the vagaries of the monarchy, and that's really all shifted. And I think that has fundamentally changed the way that Aramco has to operate, and also the policies that they have to go forward with. And right now, so if you look at the difference between 2014 and now, in 2014, prices dropped, and Aramco was committing, we're going to spend $40 billion a year on CapEx. Where Chevron, Exxon, these other companies were cutting CapEx, Aramco says, we're going to spend even more. We've got money. We've got plenty of cash. We're going to, invest, because we know that you guys aren't, and we're going to be the ones providing that oil when you're not. And now we are seeing, because of these pressures to prioritize dividends and so forth, we're seeing Aramco having to cut back on CapEx, cut back on the kinds of projects that they had, said that they wanted to do because of this low price atmosphere. And so even though they're still producing oil for the lowest cost per barrel, and they can produce 12 million barrels a day, they can get up to that. They're mandated by law to be able to increase up to that in 3 months and maintain that for 12 months. We know they can get up to that sooner, and they can probably maintain it for that long. Yes, there'd be damage to their fields, but we know that they can do that. And we also know that they have a willingness to employ that if they think that that's the right way to go. And so I think that you cannot discount the fact that they've got these other pressures weighing on them, and that's going to affect how they operate in this market, and that they're going to want a higher price for oil. I think they like a stable price in general. They're also much more oriented toward Asia right now. The policy right now is definitely to, most of Aramco's crude oil sales go to Asia. It's like 70 to 75% of their crude oil sales are going to Asia. And so as long as they can sell to the Asian market, and they think there's demand in the Asian market, they're not going to be interested in, cutting production. I think in a collective, I think they're going to want to keep their production. I don't think they want to go lower than they're going now. But it's absolutely, an issue in that they are not the same company with the same priorities that they used to be.
Okay, David Blackman, since I've known you, we've talked about the rig count, and we've talked about how it's kind of hard to measure the rig count just 6 years ago because of how much more efficient these rigs have gotten. We've talked about the longer laterals. When we look at this chart, we think about the cycle. What do we expect moving forward as the price goes up? Will the laterals get shorter? Will the efficiencies look differently? How do you think about the rig count as the price, assuming it goes up eventually? How should we think about the rig count? Because it's kind of hard to correlate rig count with price of oil right now.
Yeah, I was kind of wondering about that. Are you sure the price is going to go up?
Eventually.
Obviously, we're not going to have any significant increase in the rig count for the rest of this year, regardless of what the price does, because these companies that are drilling most of the wells are big corporations that do 6-month planning cycles, and they're executing their second half of the year drilling programs right now, and that's what they're going to do till the end of the year. If the price should go up substantially by mid-October, say at the latest, you could see some increase in drilling at the first of the year in response to that, because companies are, what's happening inside these companies right now. You have all these petroleum engineers and geoscientists who are building up real desire to go out and drill wells because that's what they do. Okay, that's what they're trained to do. I mean, just like we saw in early 2016, when the price finally started, ticking upwards a little bit, you had that explosion in the rig count because you had all that first of 2017, you'd had all that 2 years of pent up energy, desire to drill within these companies to go out and drill more wells. So that's what's happening inside these companies right now. Now, is that going to result in a higher rig count next year? No, I don't think so, because I don't think the price is going to go high enough. We have 8 million barrels a day sitting on the sidelines of producing capacity globally. And, it's hard to see how, with demand not projected to really recover to pre-COVID levels even until 2022 now, it's really hard to see how you have any significant increase in the price for any period of time, because anytime the price goes up, that 8 million barrels a day sitting on the sidelines, there's going to be real incentive for the countries in control of that production to fill that vacuum in the market and drive the price back down. So I don't see any really significant in the rig count increase in the rig count really until 2022.
Okay.
If then.
So if your assumption there is right on, what does that do to midstream companies as well? Because they have to make a living too, and they got to be moving oil around. And so, will we see mergers and acquisitions in a new way, where you see a production company and a midstream company trying to come together? Will we just see bankruptcies? Will we see the majors kind of trying to scoop them up? Is this going to be a bunch of skeletons and people picking up the bones? I'll let whoever wants to hop on and take that one first. But that's kind of, when I hear that, that's kind of what I think about.
Well, I look at the Chevron Noble transaction as a really good one. And the reason was because, for the same reasons that I just said Exxon, I think Chevron's overvalued by 100%. So they should be trading at 50. They trade at 85, or they did trade at 85. Noble, on the same relative value basis, should be worth about $10. And so Chevron was able to roll in Noble for a relatively low cost, using their equity, and get access to non-US, non-exposed to the democratic politics, not exposed to fracturing limitations of the US, and they have this great, Mediterranean asset. And so I think we're going to see more of those where you're using a relatively overvalued stock to buy. Now, midstream companies have used capital to grow their invested base year over year. But if oil comes off 3 to 4 million barrels a day in this country, which it will, for all the reasons we're talking about, the associated gas is going to come down with the average GOR of 4,000 GOR. You lose 3 to 4 million barrels. That's 12 to 16 BCF a day. You have the Marcellus, which kind of, $2 break-even supply cost, arguably. Gas at $2.50. You can maybe backfill some of the loss, but you're not really going to materially grow. And so midstream companies who already have all the infrastructure have no projects to spend on. And to David's point, people in our industry, the reason we employ so many is because of capital. And so the reason I've said that 80% of oil and gas jobs will be lost over the next 12 months forever is because if you're not doing a lot and you're consolidating, you don't need 80% of the people we have. And so coal in 2010 produced a lot of energy. It doesn't now, and there's way less companies and way less people. And oil is going the same way in the United States for those reasons. So midstream companies are in a huge world of hurt. And service companies, you couldn't even buy a drilling rig and put it to work because you're down to 80% in terms of capacity. So what you need to do is you need to take frac fleets and drilling rigs and blowtorch them all so that you can create a supply-demand imbalance. Because right now, anyone can undercut you by buying a rig at 3 cents on the dollar and putting it out for $8,000 a day. So Halliburton should be buying all the rigs and blowtorching them so that there are only 200 rigs left in the United States and they can control the price.
Yeah, Ellen, go ahead.
Yeah, I was going to say, you and FDR have very similar ideas about how to deal with a surplus. Back during the Great Depression, they were, people were going hungry and they were destroying milk and supplies because farm prices were too low in order to get the prices higher for farmers. So it's not a strategy that has not been, that strategy has been used before, just perhaps not with blowtorches.
Anas or David Blackman, either one. David, go ahead.
Well, I don't really think I have a lot to add. Okay. I've kind of even forgotten what the question was now that
we were talking about
FDR analogy threw me off.
FDR analogy got you going. About the role of midstream companies, how they play if the rig company.
Right. Yeah. Well, they're in trouble. They're going to be moving a lot less oil pretty soon and a lot less gas pretty soon. We already have a surplus of capacity.
Yeah.
On oil pipelines coming out of the Permian Basin. Now we had a huge shortage 3 years ago. Yeah. You just saw a big major project canceled last week. That was going to, build another 450,000 barrels of capacity. Obviously, you don't need that. Kinder Morgan is completing its Permian Highway line. Obviously, that line is going to be completed, and when it is completed, we're going to have a surplus of capacity on natural gas pipelines coming out of the Permian Basin. And as David said, I agree with him. I think it's inevitable. U.S. production is going to lose 3 to 4 million barrels of oil a day and commensurate amount of associated gas that goes along with it over the next 1.5 to 2 years. And that's just baked into the cake. So it's a real problem for midstream companies.
Anas, I know you want to respond. Let me add this. You've talked a lot about crude quality crude quality matters. If we do have a reduction in the amount of oil that we can put on the market, does that help some of these crude quality problems that you were worried about back pre-COVID?
Well, that was exactly my comment. I was going to say it anyway, so we're ahead of me. If midstream is going to suffer that much, then imagine what's going to happen to all those export facilities that are being built right now, and all those investments that are. I think we are going to see major cancellations in current projects, whether they are being built or they are planned. Simply, and they were warned on this a couple of years ago. So those export facilities, basically, we are going to see some cancellations, and we are going to see some consolidation too in this case. However, with the hurricanes, it seems like they played very well in terms of energy security and the flow of trade, because when we had Hurricane Laura, ships just went to Corpus Christi, for example, or other places. So there is some argument to be made about this redundancy in the Gulf. But besides that, there is no reason for the additional capacity to export. If we go back, like we heard a minute ago, if U.S. production goes down by 2 to 3 to 4 million, then crude quality is not a problem anymore. It's over. Because the crude quality issue would have been a problem because remember the IEA and others were talking about 18 million. That's where the issue of crude quality is. But if we are talking about U.S. production between 9 and 11, it's not an issue at all.
Okay, so one of the things you've also talked about is shale quality. We do have a listener, or I say a listener, a viewer who's asking about natural gas. Y'all all kind of touched on this. We don't think natural gas is going to do enough in the price to help the oil companies, as we're referring to them, but we're not going to see enough price increase in natural gas to kind of offset some of this the bleeding from these shale producers.
I mean, clearly it will help, and there are areas of the Eagle Ford, areas of the Permian that are gassier, and in a lower price environment, assuming a $2.50 price, maybe you can make it work. But broadly speaking, the reason the Marcellus grew from 0 BCF a day from horizontal shale wells to 35 BCF a day, and I include the Utica in that, over 10 years, is because it's the most prolific basin. And like Permian is for oil, Marcellus is for gas. And it's the only basin that really matters. And so for those who own assets in the Marcellus, what I look at is their firm transport obligations. And like Antero has $450 million a year they pay for unused space. That's a huge drag on their capital that prevents them from necessarily growing. But yeah, I don't think that the gas for oil players, it's a waste product. And in the Permian, we're seeing a lot more H2S, which is a major issue. And so at the best case, Halcon, before they went bankrupt for the third time, maybe fourth, it's hard to say, but they had a press release where they said their unusual non-recurring cost was their H2S treatment, which was $20 million a quarter. And if they meant non-recurring as in they'll never process that MCF of gas again, I concur. But since the H2S was never going to go down, they would have the non-recurring recurring every single quarter. And for every Permian player, that's a major issue. Add bad frac water, not using a biocide, cutting costs, and creating H2S in the reservoirs. I think that will be one of the bigger issues that people aren't talking about.
Okay. If anyone wants to hop in, that's fine. If not, we'll move on. Okay.
Yeah, I'll hop in.
Please do.
Because I think natural gas, any thought that we're going to have any significant long-term increase in natural gas that lasts a long time is kind of living in a dream world, because we have so much unused, untapped natural gas supply in this country today. It's insane how much natural gas we have in it. Just in the Eagle Ford Shale, we have an entire third of that formation that really hasn't even been accessed yet, because it's too deep to drill at these prices. Well, if the price ever gets up to $4, people are going to activate all kinds of drilling rigs and start drilling the eastern third of the Eagle Ford Shale and flood the market again, and the price is going to go down again. So every time you get an incremental increase in the price that lasts more than a few months, we're going to activate a bunch of rigs and drill the price right back down. So I think where natural gas is concerned, we're kind of on a treadmill that's going to last for decades.
The duck circle. We'll go back to the
I'm
duck
sorry.
circle.
Yeah. I'm just doing my own duck circle there.
No, what's more is, just to build on what we heard, we have several issues on the demand side. Let's say for some reason, if natural gas prices go to 370, 380, the power sector is going to dump about 4 to 6 BCF within a couple of days, and then push prices down. And if for some reason prices go up again and go to $4 or $5 for 2-3 months, Alberta has about 2 BCF to dump on us quickly. And then if prices for some reason keep going up, then US LNG, the spot LNG, is not profitable anymore.
Right.
Okay.
And that will back up some of the gas in the pipelines.
Okay. I want to talk briefly about China. You know, Ted Cruz was talking about sending ships back. To me, I'm a free market guy. If China wants to buy our oil, we should be selling it to them, especially when it's negative $400 or whatever it is. But some people were frustrated with China, what they were doing with the stockpiling. Of course, China, depending on what you think about their foreign policy, kind of depends on what you think they're doing. But they've struck a deal with Iran recently. China has a growing demand of oil. If you look at their per capita usage, they have a long way to go to catch up to where we're at. Should we be concerned about what China's doing? Should we be thankful that they're buying our oil? To me, I don't really see the connection there to people getting frustrated, but some people have. So we'll let Ellen start off with this one.
Yeah, I would say I think the way you posed that to us was China friend or foe?
Yeah.
I want to say customer.
Okay.
China, we should look at China as our customer. We want to sell them oil, natural gas, oil products.
Mhm.
And, you know, if you look, I mean, China wants to sell us also. China's looking at us as a customer too. They want to sell us all sorts of everything. They want to sell us cheap plastic toys, crappy iPads, knockoff iPads, crappy knockoff drugs. They want to sell us everything. And we should want to sell them things too, especially oil, because they need a lot of it. And as Ryan said, it looks like their demand is really only going to increase. I know there's a lot of talk of, oh, well, they're, going to make electric vehicles only in Beijing or whatnot. China is not just Beijing. China is a huge, massive country. And, so far we don't have any batteries that are going to make it possible to travel, around China, or for people who are in, farther away cities, which are also massive, huge, gigantic cities, much larger than what we think of in the United States. I think it's hard for people to comprehend the largeness of China, when we think about numbers and we think about demand. And China is they're expanding their storage capacity for oil. They recognize they don't produce enough, so they need it, and it is an important part of their economy. And so I think we really should be focusing on selling them oil and looking at them in that perspective. And I do think there's look, Saudi Aramco and these other companies definitely have the China market cornered, if you want to say. I mean, they've been working on this since the 1990s. So they've got it cornered, but there's room there because it's a growing market for the U.S. to expand there. And I do think that the Phase 1 China trade deal was a great start. Part of the issue is that they agreed to a total dollar number of purchases, and every time oil gets lower, that means they've got to buy more oil. So I don't think you can say, China's absolutely going to buy this amount of oil, but there are times when American oil, it looks more, looks like a better deal to them, and they will buy. And I think that we need to focus on that as opposed to, friend or foe, customer.
Okay. Anybody else want to weigh in on that one? If not, we'll move on to OPEC. Go ahead, Anand.
Okay. There are two issues with China that we should be careful with when we talk about their purchases. The only reason why China, market-wise, if we have free market, the only reason why China will buy from the United States because we have sanctions on Iran and Libya. If those sanctions are lifted, there is no reason for China to buy a drop of oil from the United States, quality-wise and quantity-wise. So the sanctions basically on Iran and Libya are helping U.S. producers sell to China. That's number one. Number two, China is planning on something that everyone should be aware of. When I tweeted the other day, I said, we are not going to have $100 oil. And a lot of people basically were wondering and what it means, etc. Here is the issue. China, in their next 100-year plan, they are completely convinced that there will be one day when the U.S. and its allies are going to block the Malacca Strait. And that's part of their thinking. And the only way, since most of the oil comes through the Malacca Strait, is to have a major SPR, or strategic petroleum reserves. So they need to fill up that strategic petroleum reserves as much as they can, especially when prices are low.
So
there's a problem.
How big would they need for that? Like, do they have enough room?
Well, if you are thinking about, at least based on what I heard, they want a full year of imports.
Okay.
A full year of imports. So we are talking about more than half of what the U.S. has. So we are talking probably about 400 million barrels, etc. The issue with that is the following. Here in the United States, we have regulations that govern the SPR. So it has to be used in case of emergency. Yes, politicians can play around that and use it to manipulate prices, but legally they cannot use it to manipulate prices. These laws do not exist in China. If China find out that prices are 85 and they bought that oil at 35, they are going to sell it on the spot, immediately, at lower prices again, and buy it again and again and again. So the impact of China basically is double-edged sword in a sense. It's not going to let prices go to negative or very low, but at the same time, they are going to let the prices go above 85, for example, because they are going to dump that oil on the market since they don't have regulations on that.
Okay. Anybody else on China, David or David? Okay. I know we got a bunch of questions coming in. So folks, if you want more questions, please submit them. We got about 10 minutes. We start trying to take questions. So it's about OPEC, OPEC Plus. DRW, I was picking on you earlier about your "we're at war" comment. How do you feel about OPEC, OPEC Plus today? How does it weigh in? And then we'll go back to the other David after that.
I mean, like everything, it just comes down to your political beliefs, and so the free market versus not. I think that one could make the case that, like, natural gas producers currently rely on LNG to be the export for us overproducing. Just like oil producers were asking for the export ban to be lifted so that they could export, so they could grow beyond what we needed. So, OPEC Plus previous to March 6th, I think showed a commitment that they weren't trying to crush U.S. shale. In my opinion, I think that a lot of what they did in 2014 to open the taps was related to politics and the Clintons and the Crimean invasion, as opposed to just crushing U.S. shale, because at the time, the Bakken and Eagle Ford weren't that big, and the Permian wasn't known to be as prolific because it was so expensive. And so I think about wherever we as American consumers can buy, I like Ellen's phrase, the customer. If we can buy oil cheaper than we can produce it, we should do that. So I care less about OPEC, and I care a lot more about supply demand. And there's, to David's point, there's also 1 billion barrels in storage, in super tankers, in swimming pools, in everywhere, that when that also comes back to the market over the next year, it is going to have a massive dampening effect on oil prices coming back. So I expect we'll hit 30 by the end of the year, and that we'll kind of bounce around there until U.S. producers are given zero economic incentive to drill any wells or complete any wells next year.
Mr. Blackman.
Yeah, OPEC Plus was a lot more effective when the world wasn't oversupplied by 8 or 10 million barrels a day, right? Pre-COVID. Now, it's effective just in terms of preventing the price from collapsing down to $6 a barrel like it did in 1985. But it's not. It really lacks the ability to raise prices, cause them to go much higher than they are today. They decided to put 2 million barrels a day back onto the market in August, just because they had several member countries putting pressure on the group to do that. That turned out to be, a decision that probably, looking back, was it the best decision? But they're still, as I said earlier, they still have 7.7 million barrels a day sitting on the sidelines right now. And as far as what state it's in right now, I think it's fairly healthy. They'll probably continue the agreement at least through the first quarter of next year. What they do after that will probably depend on market factors. It's hard for me to see the thing blowing up again anytime in 2021, just because if it does, then the price goes to $6 a barrel or whatever. But, again, like I said earlier, this thing is going to blow up periodically just because of the nature of what it is. And shale companies just have to find a way to do their business without an over-reliance on that thing holding together, because it isn't always going to do so.
Okay. So price war, we got the pandemic, we got low prices. Is there any good news? No, but we look at these things. So the pandemic, I think we all would think is more of a black swan type event. The price war, Ellen likes to call it a fixed price war, but that's something that we could see again. How much does that play into these shale producers, their future planning as far as their risk tolerance? Should they really kind of sit around and go, oh my gosh, at any point in time the Russians and the Saudis could get kind of mad and go at it again? Or should they just kind of put that to the side and ignore it? So I see, I don't know who wants to hop in first, but I'll let whoever wants to go.
I'll say there's good news. The good news is historically people like me who sit around and make predictions always end up being proven to be wrong. So there's your good news.
Well, that makes two, David. Don't worry. Ellen, hop in there and listen. I know we got about 15 minutes for Q&A time, so let's kind of keep our answers.
Okay.
So
I'll keep it short. I think OPEC and OPEC Plus have the same problem that they've always had throughout their 60-year history, which is that their impact on the price of oil, their ability to impact the price of oil waxes and wanes depending on how much other production is out there and what demand is. And right now we've got both of those problems converging. We've got weak demand and we've got a lot of production in the non-OPEC Plus world. And so that means that they have a limited ability to raise the price. Saudi Arabia has a great ability to crash the price. So, and I think if they want to do it, they can affect the market in that way and affect policy in that way. But, even this idea that they're pushing Iraq into full compliance, that's not going to have a major impact on the market. I mean, I can't see getting more than like $1 or so a barrel out of somehow having Iraq report we are now in full compliance and Nigeria, that's a little bitty stuff. Of course, it looks good politically and it keeps the group going, which is also another purpose of OPEC is to further the continuance of the group as a whole. So I think we're going to see that. But in terms of ability to impact the market, it's not so great. They did manage to keep prices very, very stable. We saw very stable prices this summer, which is actually something I think OPEC likes in general. I think they like stable prices. I also think that, it seems like OPEC is kind of, in a sense, undergoing a little bit of an identity crisis in that they want to be this kind of rapid response group. And they want to make decisions and change production and quotas to along with market conditions, perhaps on a month-to-month basis. And in my opinion, and this is just my opinion, I don't think that that's a good role for the group to try to take on because it's very difficult to wrangle all those moving parts. They're not like shale producers who are just making a decision for themselves. And people are also looking to OPEC for longer-term forecasts. So they want to know, okay, what are OPEC's quotas going to be for the next 6 months or a year? They don't want to know, okay, what's OPEC producing this month? And they're going to meet halfway through the month to determine next month. So basically, we have no idea what's going on.
Okay. Anas, the DRW, you guys hop in there if you want to weigh in on this one.
One of the problems we have right now is, we are talking about OPEC and its roles or OPEC Plus. I really highly recommend reading the Argus interview with the Omani oil minister last week because he is part of the GMMC and he's part of OPEC Plus. And this guy is one of the smartest people you'll ever meet. And he mentioned two important points. I think they are related to our discussion. The first one is he thinks that the price of Brent, 40 to 45, is fair for this period, regardless of whether we agree on the use of the word fair or not. But he thinks it's suitable, at least. It's suitable for this period. It's good for consumers because it does not kill demand and is good for the producers. That's one of the main results. The other result, he said that what's going to keep the compliance in OPEC is any increase in production requires additional investment. And those guys have no money. So he thinks that the lack of money among the producers and the companies is going to keep the compliance relatively in good shape. But I would like to emphasize one important point is related to BP message yesterday and the IEA message about shale when they said they used the expression explosive growth about a year ago. When I think they are not thinking about the general picture. The IEA is entrusted with the energy security of OECD at least, and probably the energy security of the world. So when they tell everyone else that, oh, by the way, shale is going to grow and is going to meet all the growth in demand, they are just telling everyone else, don't invest. Dare you invest, because shale is going to take over. The same argument about OPEC basically crashing the market is the same exact argument on the other side. So the idea with PP yesterday is, okay, what is the message you are sending to the investors in this case? Whether in shale or others, you are just telling everyone, you know what, just don't invest. We know what PP said and the IEA said is not going to happen. We know they are not going to deliver. But investors, if investors and national oil companies respond to their call, we are heading for an energy crisis. So it's not only one-sided story when we talk about OPEC. We should look at the other side, how they are scaring the hell out of the national oil companies and the investors not to invest.
So I don't know if it's going to be good news. I'm not really the good news guy. I think that's kind of my thing. I think that, I mean, there was a lot of error in what the EIA and Rystad Energy, as in particular, as two of the leading advocates for shale, could get to 18 million barrels a day. I mean, there was a reason in September of 2019 I said that the growth of U.S. shale is over forever, and the peak U.S. oil forever will be 12.8 million barrels a day. And people freak out about that, but the reality is we drilled wells too tight. I gave a speech in 2014 when oil was 75, and I said that this is the death of the Bakken. And people in the SPE, their eyes were about the size of saucers, and they're saying, how could you say this? I said, because when I was working there in 2010, 11, and we put our position together, we assumed 2 Bakken, 2 Three Forks. 1 million barrels in the Bakken, 600,000 in the Three Forks. That's all you need to drain to meet an appropriate recovery factor. And everything you do beyond that is acceleration, which maybe in a $100 world makes sense. But when you look at what Concho did with the Dominator pad, saying that they could drill 23 wells, when I did the work a year ago, I would have estimated that they needed 1/3 of the wells, and they overcapitalized it by $200 million. So I think the true well count is more like 10 per DSU in the Permian, and companies are telling people it's 20. And so the well spacing that they're doing is wrong, and it will manifest as lower B factors, higher terminal declines, steeper declines, and our rate of decline will be so much higher than people predict. We're not going to get up above 8 million or 9 million barrels for like 5 years. And so maybe oil hits $80, but there's a lot more economic oil in the rest of the world that I would rather see us develop and pay for and focus our resources developing natural gas, because natural gas is the energy of the future for our electric grid. So anyway, not good news, but that's how I sort of see that pivot with OPEC Plus in the US.
Very good. Okay, anybody else? If nothing else, we're going to go to our questions from I have here. So the first one is it possible, and I will ask, I'll pick a panelist, ask them, and if anyone else wants to respond, they can. So we'll start with you, Mr. Blackman. Is it possible with new technology, the cost of shale to be close to the conventional oil? So can we get shale cost down to be the cost of drill as we do conventional?
Well, you know, the history of the oil business, and that's another piece of good news, potentially, is the history of the oil business is that the service sector and the big companies have a long history of developing technological solutions to seemingly intractable problems. And we have a seemingly intractable problem at this point with shale, and that is simply too expensive and too resource intensive to produce at these kinds of prices. And maintain national production levels like we saw pre-COVID. So I guess we can be optimistic that that there will be technological solutions come along in the future. I will say this, though. In 2010, 2011, I did a speaking tour around the state of Texas in which I speculated that within 5 years from 2010, we would have an alternative to hydraulic fracturing as a means of producing shale from these big formations. I thought at that time that had to come because fracking is so water intensive, it is so sand intensive, it's so expensive and costly. And we haven't had that take place. The service companies worked on alternatives, propane fracs and and other kinds of fracks, but they were always just alternatives to water. They weren't a completely different kind of technology. And so it's been a real rare situation over the last decade when you were presented with this very real situation 10 years ago that the industry really needed an alternative technology that our service companies and the big companies with R&D divisions have not been able to develop an alternative. So I suppose we can be optimistic that these kinds of technological solutions will come. I talked with a company just the other day that appears to have a very viable solution, for example, for the gas flaring problem that has been plaguing the Permian Basin. But, we just don't see those things existing today. But I guess we can be optimistic that they might come.
Okay.
If I want Ellen or Anas to weigh in before I weigh in, just because technology is a hot button for me.
Go ahead, DRW.
So here's the issue. Okay, I have a can of LaCroix or LaCroix, depending on how you say it.
Yeah.
The primary factor in reservoir engineering is recovery factor. And so everyone knows if this wasn't open and I shook it up and I opened it, I would get about 10% of it pouring all over me. That is the physical limit of gas drive reservoirs. Now, the only other way to get more oil is to use a different recovery mechanism, which in this case is gravity drainage, right? And so the only way that technology brings us out of the shale revolution to the next revolution to increase recovery factor is through some sort of EOR. But EOR is way, way, way more expensive than the primary method. Look at anything in conventional when we went to water floods and the amount of processing and the size of the facility. So maybe you can control the injection of some fluid into a rock that allows you to maximize recovery factors when you have thousands of fracture faces and hundreds of thousands of perf holes around the whole thing. But to me, EOR is the only answer just because of reservoir engineering. And that's going to take 80 or 90 or $100 oil to make sense, which there's so much oil in the world between 30 and 100. I just don't think in our lifetime we're going to see that. And so we'll be moved past oil by the time we need EOR in the US.
Okay. Unless anyone wants to comment, I'm going to go to the next one. Okay. We'll go to Ms. Wald next. Based on the current market conditions, can Shale compete with the low-cost producers?
I mean, talking Saudi Arabia produces for, $2 and some number of cents. So,
right.
How can you compete with that? But I think that there's more to it than just the absolute cost per barrel. And that's also the kinds of contracts and the kinds of relationships that these companies like, and I'll talk about Aramco. I know that's like what I'm always talking about, but I'll talk about that just because that's really what I really know about. And, Aramco has really, really deep relations with China. For example, I mean, they've got a lot of joint refinery projects. They've got petrochemical projects, and all of these projects come with commitments by these companies to purchase certain amounts of Saudi oil. So at a baseline, they're so far ahead of shale companies that might want to actually compete in China. I think that we're talking about a totally different scale here. Does that mean they can't compete with Aramco? I mean, it's obviously better. That they're going to produce what we're consuming domestically. But if you want to talk about like competing on the scale of global trade, I don't think it's really possible in that sense.
Okay. Anas, yes, please answer that. And also, I do have a question about refineries. So,
sure. Just quickly, yes. Shale is cheap as a replacement to imports of the same quality.
Right. Okay. So let's talk about that. We have a couple questions about refining. Why don't we? We hear a lot of talk about we're importing oil. Why don't we refine our own oil? Why don't we retool the refineries? So there's several questions here, or at least. I think there's three. There's two for sure. Let's see. The first one is, and I'll kind of read these together. Due to the current struggle on the refining sector, how do you see shale competing with heavier, cheaper crude? Then we have one about will imports of oil from Saudi Arabia continue to go down as it has been? On some level, that is a refining question. You know how you're doing it. And then let's see here. There's one more. Yeah. Well, a lot of people seem to be stuck on the idea that refiners in the U.S. should only refine U.S. shale oil. Can you guys expand on why this is such a bad idea? And I think that's all the refining questions that we have right now. So that's a lot about refining. So whoever wants to take that, I don't know who wants.
One issue people should realize that we already hit a refining wall in the United States for shale. And that's why we export it. Yes, ExxonMobil and others tried to add. They added probably about 300,000 barrels extra. And most of the 300,000, basically, especially with Valero and others, it was kind of, they had this capacity for the last 40 years, 50 years, and they don't know about it because it was flexible capacity. So they were able to refine more of the shale. But the reason why we export, because we hit a refining wall in the United States. So we cannot refine any more of the shale. That's number one. Number two, shale quality. When we used to talk about shale quality, assuming that shale was going to go to 18, the issue was not the refining capacity. The refining capacity was just the door. It's the demand issue. Demand issue, if you look at all forecasts, you'll find out that the major increase in demand in the future is for the heavier products. And you cannot get good economics out of shale to get heavier products. One of the reasons why, because yes, can you get a lot of diesel to meet US diesel demand? Yes, but you will have tons of gasoline that has no market. And then as a refiner, you shoot yourself on the gasoline side. So your objective is to maximize every segment of the barrel, not the barrel. And therefore, you cannot refine US shale, all of it in the United States, simply because of economics and because of demand issues.
Anyone else want to weigh in on that? Go ahead, Ellen.
I'll weigh in on the why we can't refine more. Also, we can't build new refineries in the United States. The regulations are absolutely insane to the point that we're probably never going to see a new refinery. We will see retooling and possible expansions of existing refineries, although I don't think we're going to see that in the current market. We're actually seeing more refinery closures, or in some cases, they want to retool them to produce biofuels, which personally I think is less because there's a market for biofuels and more because of the renewable fuel credits and things like that companies get out of doing this. So it's not necessarily that it's a profitable enterprise, but it helps them be profitable as a whole within their general ecosphere. So we're not really going to see that. And I did quickly want to weigh in on the Saudi oil thing. So Saudi Arabia really wants to sell to Asia, but as we saw earlier this year, there was a drop in demand in Asia, and so they basically dumped on the United States. That's kind of a simplification of what happened, but they dumped it on the United States. They dumped that excess production on the United States, which Ted Cruz really, really, really didn't like. But that's also part of the free market that we live in. And so everyone's going to buy whatever crude they can to make everything work. And you also have to remember that Aramco owns the largest refinery in the United States. And so if they really want to, they can make that refinery buy their oil and not buy oil from everywhere else that they can buy. So the United States is kind of sitting there as this place where if Saudi Arabia wants to increase its production and sell more, they'll sell to the United States once they've maxed out their market in China.
Okay, David, I thought you
Just
had
a couple of things to add on all of this. It goes back to the point about the U.S. being this free market competitive environment with all these different companies competing with each other and having their own individual business models. And so you can't just say refining sector, you need to convert to do all this. So, and I agree with Ellen. I don't think we'll ever see another major refinery built in the United States, but I did interview the CEO of a company called Meridian Energy that is building right now and will open early next year a 50,000 barrel a day refinery up in the Bakken Shale in North Dakota that is specifically going to refine. It's 49,000 barrels a day, not 50, because 50,000 barrels a day requires an EPA air permit. But anyway, so we do have opportunities for refineries like that, smallish refineries that are in specific areas meeting a specific market demand. But we will never have another major refinery due to the permitting issues Ellen pointed out.
Yes, real quick on that. Tied to this loosely is we've seen what's been going on with the judges and their overturning of the Keystone and Dakota Access. Those things just drag on and on. We also have the permitting issue. We have low prices. Will this deter some of these companies from wanting to, to focus their monies here, because we're not a free market as much as we like to talk about that. We do have
sure. We're losing predictability of regulatory and legal processes in this country, and our country being predictable is one reason that has attracted so much oil and gas capital here, in addition to the resources. But I'll let others address that as well.
I think we all agree, unless there's any. Okay, DRW. I like saying that. I don't say it very well, but I like saying it. How interested will the investors be to invest in the shale companies after all of the bankruptcies that you mentioned earlier? So after November, December, and there's the skeletons out there in the Permian. What's it going to take to get the money back into the system?
I mean, so again, there's a reason I'm retired, and it's not because I don't love the industry. It's because I don't see any viable place for me to go and spend my time to build a new company. And so I think what you'll end up having is you'll have instances like Whiting. We saw another one with Lone Star today, but just you're going to take all these companies that convert all their debt, most of their debt, into common equity. They're going to come out on the other side, and they're still going to discover that they can't drill economic wells at 35. So to me, the biggest like aha moment will be when year-end reporting for 2020 comes out. The average SEC price looks like it's probably going to be around 38. If every company in the United States runs their SEC smog at 38, they will only be left with their PDP value. They will discover that at the PDP, they likely have more debt than PDP at that price deck, which is going to accelerate the number of bankruptcies. And until such time as the world oil market demand, supply, et cetera, balances and raises prices, this is going to be a zombie land of companies not doing anything. So to me, I don't see recovery until 2022 or 2023. So for all the entrepreneurs that are like, now is the time to buy, there's blood in the streets. My message to you is the blood has not even started. And that 2022, 2023 is really when we're going to see that manifest, and that there would be opportunities.
I'm sorry, 2022, 2023. I'm sorry, I'm going to cut you off there.
Ryan,
yes,
will you do me a favor? If you put the slides back, and I want him to comment on the slide immediately after the slide we finished, where we have that duck, because these are slides from Pioneer and Centennial. Yes. Okay. So I'm not going to say anything here. I just will let him comment on this slide and the slide after, because they are showing a decline in cost and what the cost is, what the break even is. And this one is from Diamondback at different oil prices, and look at the fine print. That's one of the, so I will let him comment on that, because I think this is really a reasonable thing to do.
Yeah, I mean, I guess the question is, do we really believe that a 10% rate of return is what investors are investing in energy for, given that there's all these forces, both geopolitical and regulatory, that always seem to, like, unless you hedge 100% of your volumes, which companies haven't done, and as you said, and us on service companies, I'm not sure the service companies were really making money. And so it's all well and good for a company to come out and say, well, we're getting frac stages at 14,000 per stage. That's not profitable fundamentally for the full value chain. And so, yes, does Pioneer have some great inventory? 100%. But they're making assumptions on EURs and spacing that I think there needs to be more detail dug into. And when you dig into that, I think you find that there are less wells that are commercial, and we'll see the 2021 capital budgets. I think that they will be much, much lower than people think. And that the November dates I talk about, everyone's going through budget planning right now, and they're looking and they're going, man, like, we have 40% base decline, 40% loss of cash flow, 40% reduction in price. We better have a 60% headcount reduction and then just survive until all this is gone. So anyway, time will tell, but that's sort of, I don't see those costs as sustainable, and I don't think that most companies have the inventory that Pioneer has.
Anybody else? Okay. Let's see here. Do the panelists agree that there is an outsized G&A to barrel issue for small and mid caps? What is your opinion on how and when the G&A issue will be addressed?
November.
I think David just addressed that right away.
Okay. So I was over here in my own world. I'm sorry. Did you get it? There you go. We've answered it twice then. How about the future of shale in different countries such as Saudi Arabia? So I think they're asking, is there a future for shale exploration in some of these other outside the U.S.?
I'll take that, and probably Ellen has something to say about it too, because she studied that. Generally speaking, we already know that they are producing from shale right now. They are producing gas in the Northwest, and they already have some shale in the Eastern province, and they already basically drilled wells, and they are actually producing, and they are planning on expanding production. Around the world, basically, in terms of oil, we have only in Argentina, but that's heavily subsidized. And we don't have anywhere else really something to talk about. We heard recently that Russia is trying to get into it, but it's not really shale. It's some sort of other rock.
Other rock. I like that. Other rock from Russia. Yeah, I think Saudi Arabia has been looking to get. I talked to a guy back in, I think it was like 2015 maybe, who had been out in Saudi Arabia, you know, talking about best environmental practices for shale drilling. So, you know, back then they were already planning on getting into this. They need the natural gas. I think when we talk about shale in Saudi Arabia, we're there. It's really going to be focused on natural gas production, because right now Saudi Arabia has a natural gas problem, if you could put it like that, because most of their natural gas production comes from associated gas, and they capture almost all of it, and it feeds into their power plants and their electrical grid, and that's how they've been able to move off of direct crude burn, which is fantastic and great both for them as a company, but also for them environmentally. But their electricity demand is growing, and if they're not producing, you know, more oil, then they need to get that gas from somewhere. And they've talked about importing it. Obviously, the best scenario is for them to access the natural gas reserves that they have through fracking or otherwise. And so I think we're going to see that expand if we continue to be in an era where Saudi Arabia is cutting back its own oil production for the sake of global oil prices. We're going to see their natural gas production growing, possibly at some point to the extent that they're able to export it if it is profitable for them. You know, remember I said, like, they plan for the really, really long term, even though they're being forced to do a lot more short term stuff now. They like to plan for the long term, and that is a long term.
Shale in Saudi Arabia, since it is in the Northwest, it has very interesting dynamic and economics. It is profitable at any price, literally. And the reason why, because the power plants in the area, which is Daba power plants and close to Tabuk, they have literally to ship the oil from Ras Tanura, and the ship will go around the Arab Peninsula all the way to the Red Sea, and then it will unload in Yanbu port, and then it will be trucked for about 400 kilometers, and you'll see hundreds of trucks destroying roads and daily accidents. In fact, that highway is called the Highway of Death because of the number of accidents, until it reaches the power plant. So to have gas next to that power plant, if you just the cost of shipping itself justifies the shale in that area.
Can't hear you, Ryan.
Okay.
There you are.
So I'm going to exclude Anas and Ellen because Anas answered this question on the Texas Oil and Gas podcast, and Ellen on Energy Week. So for the two Davids, what do you think about BP's big announcement yesterday?
I've forgotten what it was. I got to be honest with you.
Basically, the demand will never return to 2019 levels.
Oh, yeah. I don't believe him.
You're pulling a Ryan.
I don't believe it either.
Yeah.
I don't think. I mean, again, it's just there's too much. What does wind do? What does solar do? What does batteries do? I found it interesting that they said they sold 150 million cups of coffee, as though that's going to drive their business. Like, what is going on with BP? But yeah, I mean, they're really caving to European investor pressure, which clearly has impacted the U.S. here. And they're coming up with things like, "Don't worry, oil's not going to grow." But like, if you think about tier 1 drilling locations, we're now to tier 2. Well, tier 1 wind locations are kind of taken too. And so, yeah, maybe it's profitable, but if it's 60% as efficient, and then there's all the things on the horizons and birds hitting, like, we're going to have a backlash at some point, and then we're going to find that energy is important for our world, and that if we truly want to invest in fixing the climate, 74% of electrical generation in Asia is coal. So if we really want to solve the environmental issue, since there's a no peeing section in a pool, let's go to Asia and help them install more wind and solar. And then ta-da, climate is solved. So I think BP is just being like...
Yeah, and let me add one thing to that. I'll name one name, and that's BP. Look, BP does a lot of things for PR. They say a lot of things publicly that are strictly for public relations. They've made this big announcement that they're going to net zero by 2050. They wrote a letter just this week, urging the Texas Railroad Commission with Shale, urging the Texas Railroad Commission to go to net zero flaring without specifying a date by when they're going to do it and any company commitment on when they're going to do it themselves in their own company, right? And so I look at that thing about demand yesterday as just kind of PR to support their campaign to go to net zero by 2050.
It seems to ignore the math. If you look at the India, China, Pakistan, we keep talking about Asia and just what their per capita oil usage is and what their median income, the low end of the median income in China is $3,200 a year, something like that. So unless you just presume those people are going to live in abject poverty, which is only 400 million middle class, you get the numbers. It's almost impossible to see that we've hit.
People simply don't think about population growth and the need for third world countries to come out of the squalor that they're in. And the only way you can do that is with fossil fuels, and oil demand is going to get back, and it's going to continue to grow.
Okay. I don't know if anyone knows this. If you do, please answer. Where is the surplus oil field equipment going? Is it overseas? Is it getting blowtorched? Do we actually know? Does anyone have an answer to that? I don't know for sure. Stacked up in the yard, probably somewhere if I had to guess. Okay. All right. Where do vertical wells play in the future? Because it's a lot driller to drill and produce those. So you don't hear about a big announcement of a lot of vertical wells, but they are a lot more lucrative as far as the margins go, it seems.
So pull up the EIA report on U.S. production between 1973 and 2005, and I would argue 2008. And that was the U.S. conventional business. And there was a reason when I started my career in 2000 at Anadarko that like F&Ds were going up every year. Exploration wells were not hitting successfully. And there was a reason that we went to the shale revolution and that there was a concern about supply, like not having enough in the world. And so everyone says, oh, I can go drill some verticals. Yeah, maybe if you're a Kansas City family office and there's some small bump that you want to go drill and make some money for your family office, cool. But for Exxon, Oxy, Chevron, everybody, they do not have the scale in the US to develop conventional assets because all of that has already been produced. And so to me, US E&Ps need to consolidate and they need to start bringing their expertise overseas. And so, Ellen and Anas know a lot more about the shale development overseas and in Saudi Arabia and the Middle East, but presumably oil basins have shale basins and there's a lot of equipment that we could bring over there and produce it cheaper. And to the extent that they want our companies there instead of a national oil company, that to me is the investing future. Going back to vertical wells is not a realistic belief.
Right. So the distinction there is the names that we hear in the news, this isn't viable for them. There is a large sector of the oil and gas industry that's people we would never hear of, just mom and pops that could go out and make a good buck drilling the verticals. It's because it's a different business model with different margins, right?
Yeah, for sure. I mean, you can open a movie theater too. There's lots of ways to make money.
Open a movie theater right now.
In Jacksonville.
Okay.
In Saudi Arabia.
Saudi Arabia, maybe. Okay. We talked about the refining. Okay. We talked about this earlier, EOR. Where does all this push EOR? Investment into EOR, A&D for EOR. So anyone wants to take, where is the future of EOR? Dead?
Yeah, someone else can take. I mean, I don't think it's commercial in any foreseeable future. And so, again, will it play a role? Will oil prices go higher? But for all the reasons I described, equity valuations are too high, and most companies need to go through bankruptcy. So you do not want to be a shareholder in any of these companies. Even if oil goes to 60, that will not save them. And so EOR doesn't save them either. Maybe in 3 iterations of Chapter 11, 22, and 33, the company before Chapter 44 is the one you want to buy.
Okay. Anyone else? If not, we got one about Iran. Sanctions, obviously, Trump administration loves those. If Biden wins in November, does that change anything? Will we see go back to the Iran nuclear deal or something else? Any thoughts on how a Biden presidency might change our relations with Iran? And then obviously a Trump 4 more years, what might that do? So Anas, Ellen, whoever, David Blackman, whoever.
Go ahead, Alan.
Oh, sure. So I think there's actually a lot riding on in terms of policy, Iran being one of those policy issues with the election. And I honestly think I don't think we have a good sense of what a Biden administration will do vis-a-vis Iran. We had, we heard certain things in the Democratic debates. I think we need to see debates. We need to see a foreign policy debate and see him answer questions about this in order to get at least some sense of what the possibilities are. Because I know, when they asked a lot of the candidates about sanctions on China, there was not a universal move to say get rid of those sanctions. A lot of people thought that, well, now they're there, we can't just get rid of them. This is a policy that has to be maintained. And so for people who think that a Biden president would mean the end of sanctions on Iran like day one, I wouldn't make that assumption unless we actually hear it from the lips of the Biden foreign policy team, because it's not the kind of policy you can just magically roll back. However, I do think that if that did occur, we would see a relaxing of sanctions at some point, and that would definitely mean more Iranian exports on the market. But at the same time, and same with Venezuela, by the way. I think sanctions on Venezuela would also be relaxed. I don't know if we'd see them all disappear immediately, and that would have a big effect. I think that would have a very big effect on the market. But at the same time, we have to remember that the oil industries aren't necessarily in the greatest shape. Iran, I mean, look at all the problems Iran was having when the sanctions were relaxed the first time before the reimposition. They couldn't get anyone to come in and do their new Iran petroleum whatever deals. They couldn't get anyone to come in. They kept canceling their shows over and over. They've got a lot of internal issues with their oil industry. A lot of them are constitutional in nature, and it has to do with how much foreign investment and foreign control they are prepared politically to allow in, and that hasn't changed. So I think that's a whole other kind of fish to look at. When we come to that, but there definitely would be, we would see the resumption of at least some Iranian exports, possibly 1 million barrels a day on the market.
Anas,
yes.
I'm gonna run through. We got a bunch more questions in just a few minutes. I'm just gonna run through them and just fire them off here. Anas, ban on. There's talk about a ban on federal lands, the BLM lands. How big of a concern should that be for oil and gas producers in the U.S.? Will it really shape the industry much, or is it overstated problem?
Okay. John, let's go to Biden first, the issue of Biden. I am getting frustrated with this question about Biden and Iran for a simple fact, because the true question is, what would the Iranians do, not what would Biden do? Really, that's what it is. Will they accept a new deal or accept the old deal? I don't think they will accept the old deal for a simple reason, because if every new president is going to change it, they are not going to go for it. So they want a deal where the Senate and the Congress is involved, so a new president cannot change it on his own. That's number one. Number two, the first day Biden is going to win, Iran is going to increase its visible exports. The first day. Why? Because they know he's not going to enforce the Trump sanctions. So, and when some media outlets are going to report an increase in their exports, no. Those exports are becoming more visible. That's what it is. I think the net increase is going to be minimal in the first few months, simply because they are smuggling a lot of oil.
Right.
Okay. So that's it. On the Biden issue regarding the ban on fracking on federal land, I think that's the only thing they can control, and that's the only thing they can do. They are not going to go farther because they cannot annoy a lot of people. This is the least annoying thing to do, is to ban fracking on federal land with like 20 exemptions.
I like that. Least annoying policy.
Okay. Can I address those questions?
Please. Go ahead, David.
On the Biden and Iran question, I'm really more interested to know what Kamala Harris thinks, because I don't think Biden will be president very long. On the federal lands thing, he's serious about that. My view of that is that it's just one more way the Democratic Party is trying to change the deal and reduce regulatory certainty for the oil and gas business in this country, and it'll have a capital killing effect. And that's where I'll stop. Go ahead.
Yeah.
Next question.
Real quick, no one thinks that they're going to push this to the private land. that's too far, unless you saw some kind of Colorado Water Act or something like that. Like we wouldn't see.
They can impact you on private lands through the EPA.
Yeah,
through the Water Act.
It would be something
Water Act.
Yeah. Okay.
Yeah, I think you have to use the Colorado example right now with the fact that Proposition 112 was voted down, and immediately after they came with SB 181, and they're talking about the exact same setbacks as was covered in Prop 112. So,
why are you investing in Colorado?
Colorado is uninvestable, and so I think the fracking ban is obviously a major impact. But if New Mexico goes that way, or if Oklahoma goes that way, or I don't think Oklahoma, Texas would, but it's deeply concerning, I think, if you're an oil producer in a Democratic state.
Okay, we got like 4 more questions in 5 minutes. So let's see if we can get through them. Canada, what role will they play? If I was a Canadian, I'd be concerned because you can't get your oil down here, maybe with all the pipeline problems. What do you?
As a Canadian myself, or at least partly Canadian, I can say, I mean, the way that the government is going there is so much worse than what we're seeing in the U.S. Yeah. They are so green, they are so virtue signaling. Justin Trudeau is an absolute disaster, and so until the Canadian politics revert and go all the way right wing, like we've seen in some of the European countries, I just don't think that Canada is a viable investment climate either for oil and gas.
Okay, this is DRW because maybe you've talked about the loss of jobs. This is addressed to you directly. What does a recent petroleum engineer graduate do over the next 2 to 3 years before the sector turns around? You're going to hire him as an intern, maybe?
I mean, I would leave the industry. And you can email me anytime at drw@hottakeoftheday.com. But the reality is, if we lose as many jobs as I think, for every position that's open, there will be 4 to 5 applicants minimum, and all of them will have 20 years more experience than you and willing to take less salary. You'll never be able to get your career started. You do data, there's 50 million unemployed Americans because of COVID, actually, not what the Fed say. Go change industries. Other industries have real problems that they need to solve, and they need your smart brain. Oil and gas does not need your brain.
Okay, we talked about this loosely, but I'm gonna ask it again. Do you see people going back to vertical unconventional wells to reduce capital risk, especially like tight spacing for the EUR? The answer to that is going to be no. We don't think the big producers are going to deal with that, is the consensus there, I think. What will happen to exploration in a declining demand world? Who wants to take that?
Well, look, we have exploration going on all over the world right now. ExxonMobil's in Guyana, Apaches, right. Suriname, off the west coast of Africa. There's exploration going on all over the world, even at these prices, because these are elephant kinds of reservoirs of easily to produce product. And so that's going to continue regardless of what happens to the shale business in the United States.
Go ahead, Anas.
I'm going to make the following statement to answer this question. By 2050, we need more than 700 million electric vehicles on the road to keep the demand for oil at the 2019 level. Okay? But to have 100 million barrels of oil in 2050, all of that has to be fresh oil.
Mm-hmm.
All of it, because of the decline rates.
Yeah. Okay. So when someone does have a question about using shale to kind of be a blend for the heavier crudes, is that going to be our role moving forward? Can the Saudis produce enough to kind of blend themselves? What are your thoughts on that, Ellen?
I was saying Saudis love to sell Arab Light, so that's what they love to sell to Asia, and so I think that you really want to look for a source of heavy crude. I mean, Saudis produce heavy crude. They got that. So can Iraq. So can Iran, if they can. But so can Venezuela, and they've got it. Now they're basically producing nothing but a complete turnaround for Venezuela could be possible if we're talking about between now and 2050. There are a lot of things in the realm of possibility, and we could also see Alberta turn around. So it's not like there isn't heavy crude available to produce in the world. It's just not really, a lot of it's not being produced now, either because of where it is or how costly it is or the transportation issues with it. But we can produce that, and if it's really needed, it will be produced.
Okay.
Generally speaking, just one quick comment. Generally speaking, in a world where we have surplus, a refiner would prefer an original oil over a blended oil.
Yeah. Okay. So we're going to start with Miss Wald. We'll go ladies first here. So here's what I want everyone to know. First off, thank you guys for your time. You are all super busy, so really appreciate this. If we have some questions about being on demand, this will be in the War Room newsletter. You will get email from the War Room newsletter. You can get it there. You get a free 30-day trial for that, and you get this replay. We also have one on the future of U.S.-China relations coming up in October, so if you want to subscribe to that. So we're going to start with Ms. Wald. Ms. Wald, I know you don't like making predictions, but how long will we stay sub 50? And then feel free to plug, promote, tell people they can find out more about you or anything else that we didn't address that you might want to get into in 30 seconds to a minute.
Sure. I hate making predictions about the price, but I definitely think through the end of this year, if not farther. I'm not the Ed Morris Citigroup optimist in this case. In terms of where can you find me? I write a regular column on investing.com, so you can check that out. I'm also on Forbes. I also occasionally write on Bloomberg. I have a recent column out there today about kind of OPEC at 60. And you can reach me on my personal website, ellenrwald.com, or also on my company website, which is transversalconsulting.com. And absolutely, of course, you can find me on Twitter at Energized Economy. And I'm sure Brian has tweeted that out a lot. So
yep, there we go. We'll go next to Mr. Blackman, since you're right there up top on my screen, at least.
So I suspect, as unpredictable as oil prices are, some event will cause the price to go above $50, the Brent price go above $50 at some point early next year, probably. But over a long term, not until 2022 at the earliest. As far as where you can find me at Forbes.com. I'm a regular contributor there. I'm the editor of Shale Magazine, which is shalemag.com. I write there almost daily. I quit Twitter last year because I got tired of all the nonsense I got there. So that's where you can find me.
DRW, where can people find you at? I'm
probably the only one that's like active on LinkedIn. I think I was active on LinkedIn before LinkedIn was a thing. But you can follow me at hashtag hot take of the day on LinkedIn. I have a website, hottakeoftheday.com. We have a podcast, which is fun and talk to a lot of interesting folks like this. And you can check out my book if you want to understand the man, the myth, the legend before he became DRW. It's called What the F is Wrong with Everybody Else, What They Didn't Teach You in Business School. And it's a personal journey about how I didn't get divorced and ultimately saved my marriage and found happiness in my life. So that's the only good part of my happy story.
Okay. Anas, we'll let you close it out. How long are we sub 50? We do have one question that came in about the petrodollar. Ellen and I will answer this on Energy Week, and I will email it to the other panelists to see if they want to answer it. But we'll be on Energy Week next week. We'll answer that because we're out of time. So Anas, sub 50, where can people find you at?
Generally speaking, it's probably the easiest way is just to get Twitter, Anas Alhaji, ANASALHAJJI, and from there they can get to all the other things there. But in terms of forecast, we are getting to a period, I think, to sum up everything we talked about today, the fact that we have a mismatch between a decline in investment and a decline in decline rates in shale, and that's going to lead to shortages. Yes, we have massive surplus right now. We have about 200 million barrels in storage, and then we have about 7 million in spare capacity. Until we eat it up, it will take time. But it seems that we are heading for a major energy crisis because of that mismatch between the investment and the decline rates.
Okay. And let me just say this real quick for the viewers and for the panelists. First off, thank you guys. It's first time meeting DRW. I know the other three decently well. You always get asked when you get to be around these celebrities, what are they like? And they've all been nothing but nice and gracious with their time. So thank you guys very much. And I will say, if you felt like you're shorted, or if you're watching this video and you go, why did he short so-and-so a question? It's hard to keep up with who's been asking what. So if you felt like you were shorted or I was shorting someone, I do apologize. I did my best to try to get everyone as much airtime as humanly possible. So guys, thank you so much for this. And everyone that tuned in, we appreciate you guys as well.
Thank you.
Thank you.
Thank you.